this is like my standard chart that you guys are seeing here, minus the DeMark indicators. So it's the S&P 500 monthly bar chart with an Ichimoku Cloud. That's the shaded area. Now, for those of you that have the cloud on your own charts, there's more components to it that we remove from the chart itself. And we only do that because we use a lot of moving averages, and we felt sometimes they were somewhat duplicative. But the cloud itself will show the prevailing trend, which you can see is actually still a secular bull market. So I always say to people, well, that's the good news. And then within that context, you can see how it would frame at times support, other times resistance. Notice how the cloud going forward has sort of flattened. So it gives you this kind of like forward-looking element to it. And that flattening of the cloud to me suggests that we're going to get into a more difficult environment. I'm guessing that more difficult environment will be instilled by yields, what I think is a secular shift in treasury yields. So not to say that we won't get back into a bull market cycle, and we could actually do so very soon based on my work. But I think it could be more of a kind of a this, right, instead of a this. So maybe no longer the kind of like cyclical bulls that look more parabolic. I think we might not have as many of those, at least in the near future, maybe the next 10 years or so, based on the trajectory of yields, which we'll get into to some degree here. But notice here also we have some levels. So with the S&P 500, we're looking at some Fibonacci retracement levels as long-term support in addition to the cloud. 3,500 is a pretty major level, and we saw that tested successfully in October. And what we've seen more recently suggests we probably won't get back there, at least anytime soon. Doesn't mean never, but not likely in the near term. So I guess that could also be perceived as some good news. So if you take those same indicators and you kind of zoom in, which is what we do in our process, we kind of start with the monthlies, we go to the weeklies, we drill into the dailies for market timing. With the weekly charts on the cloud model, you'll see that we came right up against the cloud-based resistance. So some of you may have heard of us talking about 41.55. That level is simply based on the upper boundary of the cloud, so that's our resistance level. Above that level, and I don't know if Rick Bensignor is here, we look for confirmation as per his methodology, so he taught me a lot of what I do. If we see consecutive weekly closes above that 41.55, that would mark a confirmed breakout, sort of like a bullish reversal, maybe not with 2 years or even 1 year of implications, but several months of implications. So we would be happy and welcoming of that kind of breakout. But for now, there seems to be some short-term downside risk. You'll notice that in the bottom, there's a stochastic downturn. So that's an overbought, oversold measure. That downturn, or actually no, it's a downturn now, but it wasn't a week ago. These were run a few days ago. Thanks to my analysts, Will and Kevin, sitting right over there. Hey, guys. And now we also have sort of a subtle negative divergence in the MACD histogram. So looking at the Nasdaq 100, this is one of the reasons we think perhaps we can get a breakout above that cloud. And that's because the Nasdaq 100 got through some Fibonacci resistance of its own. The outperformance that we've seen, of course, has been largely driven by the mega caps. And I think this is the source of many of our frustration over the course of sort of 2023, because it has been indeed sort of a narrow rally, if you want to call it that. Not everything has rallied, but the participation has been really, really somewhat narrow when you also reference the outperformance by the mega cap complex, which we'll look at. But you'll see that within the context of its breakout, the Nasdaq 100 index is now overbought or reacting to an overbought condition after its phase of outperformance. That all said, so while we think it should pull back, you can see how it could easily make a higher low. So perhaps near the bottom of that cloud, and also in relative terms with the ratio in the bottom window versus the S&P 500, that ratio looks like it could make a higher low as well. So near-term underperformance, but likely to give way to sort of a phase of outperformance. So we would want to sort of welcome pullbacks in these names. So Apple, Amazon, Microsoft, NVIDIA, all of the mega cap stocks that have driven that Nasdaq rally and outperformance year to date, you can see that they look stretched. Microsoft had a gap up in earnings that we suspect might be exhaustive since we published this. But needless to say, we don't think they're off to the races here long term. We would welcome a pullback, because then on the back of that, we could have this opportunity to add exposure and take advantage of sort of the next bull cycle for these names. The small cap benchmarks like the Russell 2000, this is IWM representing that space, you see the underperformance there. In the bottom window, that ratio has really just fallen off. It's quite oversold at this time, so it suggests that we'll see a little outperformance small cap versus large cap, and it also would probably implicate that we'll see underperformance by the mega caps in turn. Now, the question is, how many people think this is a basing phase, the range that we've seen in IWM? Anyone? John, good? Couple? Not many. And how many think it's a continuation pattern? A little bit more. Okay, I'm not getting great participation, but I gather it probably means that nobody knows, right? It's a trading range. That much we know, right? So I want to think it's a basing phase. I do. We won't know that, of course, until we have a breakout, right? So we want to get above that resistance based on the highs, based on the cloud. But here's what makes me nervous as well. Okay, KRE, Regional Bank ETF. The regional banks have broken down from what kind of looked like a pretty similar range. So they're not setting a very good example for the market, in my opinion. And fundamentally, certainly there's some issues there as well. So it's not to say we think this is what's going to happen to the market, but it tells us not to get ahead of it, right? So not to get ahead of a breakout, not to get ahead of things without having a really good positive technical catalyst to act upon. Because there is still some risk to the marketplace when we have the overhang of that cloud. So, to sort of be in following with what we said, that the topic of this presentation is how to navigate bear market cycles, I think the message here is that the momentum is obviously important, but also the cloud, referencing the cloud, and we believe on the weekly chart as a gauge of sort of the most tradable trend there is of several months in duration. Having the cloud on your side, I think, is really very much key in a cycle. Looking at the growth value ratios, I think these are really fascinating right now. And we looked at perhaps the ratio for Nasdaq 100 versus the S&P 500 as likely to give way to a pullback. Here too, we should see the large cap growth versus value ratio pull back. But there are some indications, especially looking at the small cap comparison, that we have seen a rotation into growth that's somewhat meaningful. So when we see this pullback, again, growth versus value, small cap and large cap, we would welcome that as another potential buying opportunity. Another bit of good news, we highlight the VIX often in our work, and we do that because, and again, I kind of harken back to what Bob said about actions versus words. The VIX to us is a transactional gauge of market sentiment. So we always adhere to that, and we believe it still matters. I know there's always speculation, but to us it still is sending a message that's meaningful. And with the VIX having broken a long-term support level, that can be perceived as a market positive. It doesn't mean anything for the near term. In fact, near term, because we're looking for a pullback, we have this short-term momentum behind the VIX that's to the upside. But longer term, it actually suggests that perhaps we've moved from what was, I wish I had a pointer, but like a higher volatility regime to now a lower volatility regime. And so that would be a good thing maybe for the next 6 months. So kind of bodes well for the second half to be a little bit easier in terms of trend following on the upside. So looking at the Fear and Greed Index, this is on cnnmoney.com. I love it. I think it's really just informational. It's not always super timely, but it aggregates, I think, 7 different reads on market sentiment. And it's when it gets above the red mark that it's somewhat overdone. We last had a reading that was there in February, and that was a pretty timely indication of a corrective phase within the context of this range that the market has been locked in for several months now.